What we're going to look at today is primarily the stochastic modeling tool. And Matt will go through that, and that's point to the Monte Carlo simulator. But what we're going to do is just look at some drawdown in cash flow initially. I've been running some webinars like this just on the cash flow tool. And at the end of those webinars, we invite the attendees to give us feedback and say whether they liked it or disliked it and what else they wanted to see. And quite a few people said they wanted to see the Monte Carlo. Matt uses it more than me. Okay, so he's a great lover of the Monte Carlo tool. So I've invited him to do most of the work. So shall we go live, Matt, or do you want to take over from this point and do a bit more?
Yeah. No, that's fine now. Thanks, Ray. So just a quick, as Ray just sort of alluded to, so yeah, I'm an active chartered financial planner, looking after a good number of clients, and as a business, we look after a good proportion of clients in the South Wales Valleys and surrounding. What I thought we would sort of pick off today is that obviously hot topic at the moment is sort of the particularly with assessing suitability 2 that has just been announced by the FCA. Focusing in on decumulation strategy and consumer outcomes in relation to drawdown post pension freedoms. So what I think has been battered around quite a lot in the industry of late is how do you go about proving that the advice you're providing is robust? How do you show that using cash flow planning? But also, what other alternative ways have you got that? And the age-old sort of battle continues to rage about whether you do linear returns or variable or stochastic modeling. So, as Ray sort of mentioned earlier, is that CashCalc is a tool that is designed to help you do your job, not replace you as an advisor. So what we have done is provide you with the tools to be able to show your advice in as many different ways as you like to. So what I thought we would do today, I'm literally going to jump straight in for a second and just show you a very basic Monte Carlo, just so for any of you who don't know what Monte Carlo testing is or stochastic modeling, give you a very, very quick overview of the fundamentals of that. So what we've got here, I've just dived straight into an example from this. If I'll just jump back to the dashboard and show you where the Monte Carlo is for any of you that haven't seen that. So if I draw your eye to the center of the screen, we've got the cash flow modeler in the center. We've got the onboarding tool at the top of the screen in the bright yellow, which is our, now becoming our absolute fundamental piece of kit where you get the clients to onboard themselves. We've run another demonstration on this in the last few weeks. And we've now, we've got in excess of 2,000 people, a month filling in their own, so clients filling in their own capture forms. In my firm at Niche, we've got a 93% return rate on those as well. So if any of you do want to pick up the client onboarding piece, I think that's really important. We have got the webinar is recorded for you to be able to have a look at, but if not, drop us a call and we'll be able to point you in the direction of that. But what I'm going to draw today, just quickly, let's jump over to the Monte Carlo. So Monte Carlo is classed as one of our core tools. So whether you're taking the other modules that we've got, one of the core tools that we've put in play is the Monte Carlo. So at the 2 o'clock on the clock here, if I click into this one, and we've got pension drawdown Monte Carlo simulator. Hopefully you can all see that. So I'm just going to click into this one, and I'm going to go into a basic testing example for you. Now, what we've got here is I'll show you how this works in a second, and this is the reporting engine. So this is the pretty graph that comes up, and as you can see, it's saying calculating. So just going to give you a very, very quick overview of what this is designed to do. So if I draw your eye to the left-hand side of the screen, and you can see the assumptions page, the assumption section. Now, for any of you using the cash flow, the assumptions is always the first section. So just set a couple of things. What are we actually looking to achieve on this example? So in this instance, I've got I've put into the system here that we've got £1 million investment, whether that's in a pension or other type of investment. So that's the first option we're going to put in here. The second entry box that we've got here is, as you can see, it says pension should not drop below. Now what this is if for some reason you wanted to set a floor. So for example, you said, look, I've got £1 million, but I never want that to drop below £500,000 because I want to leave that to my children when I pass away, or I've got a specific goal that I need to use this later on, so I can use it in the meantime, but I have to make sure that there's £500,000 left. You can put that in here, and I might show you that later, but I just want to jump to the next section. The next little section you've got here is, and this is one of the important parts. So Monte Carlo testing, is running your scenarios through something in the region of 10,000 randomly generated scenarios. Now that comes from having, and how we establish how those are going to be articulated is between the maximum return we've ever had on a selection, on an asset allocation, and the minimum we've ever seen. So what's the worst and the best years we've ever seen of those? And then we just run that through. We have a couple of standard deviations and all those other mathematical parts. But from everyone here is we're going to run 10,000 random scenarios with 10,000 randomly generated inflation rates. And what we're going to see is how many of those scenarios would the drawdown that we want from this pot still work. Now, in this instance, what I thought I'd show you is that we've got a £1 million pot. I'm going to just put this in cash for a second. So there's an asset allocation drop down here. Now, when you first log into CashCalc, and if you've never done an asset allocation template before, this will only show you what's called the CashCalc default asset allocation. Now, what we've done within the CashCalc team, we have an independent research team who's put together 30 years worth of sector data. And if I just hit this show button for you, you'll be able to see that this is an asset allocation. So what we've been able to do, along with our in-house research team, we've brought in some data from a discretionary fund manager. We haven't published their name because we only update this asset allocation once a year. Obviously, the discretionary fund managers might be updating their asset allocation more regularly. But what we've got is that they've given us a series of asset allocations that, basic asset allocations that we could utilize. And what you can see on this screen is that we've got some standard sectors that we've input. And we've then got the minimum return that's ever had over a 12-month period was -9, and the maximum was an 18% return, but the average being at about 5.3%. So this is a risk profile 3. I just quickly show you, we've got a slide in. You can pick any of those up, hit the show button, and as you can see, that's a risk profile 6 now, and you can see the minimum has now changed to -23, but the maximum at 36, and the average has risen to 6.24. Now, some of you might be looking at that saying, well, I can't use that because that doesn't apply with my asset allocation. So one of the options that you have within the CashCalc system is this big pink button here at the bottom of this box is the asset allocation template builder. Now, if I just quickly click that, that'll take you through to the asset allocation template page. Now, what this allows you to do is click into here and build a new. Now, if I just call this the 1, 2, 3 test, and I'm going to now add my individual sectors. If I hit add, you can see that we've got sector data, and we've got 29 years worth of sector data, and you can just go through and click the specific items that you might use. So if you're using just DT or Oxford Risk or one of those other attitude to risk and tools, what you're able to, and it turns out that attitude, that asset allocation for you, you can go in and build that in yourself. So if I just click global, a European, bit of Asia, and I'm just going to pick a bit of money market. We'll have some property in there and some corporate bonds. I'm just going to update that template, and I'm going to click into that, and then this is then what you're going to get. So you can then go in and put your specific weightings. In this instance, if I just leave them all as they are a second, so equally weighted, you can see that this then produces you some historic weighted growth rates. Now, this is based on the sector data, so it's obviously not going to be necessarily applicable to your specific funds or your models, but I'll show you, you can go off and do a variable growth template, which I'll show you a little bit later. But if we then run our mouse along this section here, we can see that there's that maximum growth of 45% in this one, and we've got some, some big minimums here, -19 here. Can't quite see that one. But actually here, if I just scroll down slightly, minimum of -19, maximum of 45, average growth rate is 7.3. So if we had that asset allocation, potentially this is what we'd have seen over the last 30 years. So I'm just going to hit update on that one and then close it. So what we're saying is, look, we can provide you with some defaults, which we've gone and sourced for you from the industry, but you can go in and put your own in as well. Now, if I just take us back to the Monte Carlo a second and show you why we use this information and how. So in this instance here, we've got a risk profile 6. Now, in that first example, if I just drop this back to cash, and I want to show you this. Let's say we've got £1 million, and what I want to see now is, let's just see if we were to take £40,000 a year level. So actually not, most of the rest of the system in CashCalc is done in today's terms. So we're always looking to that when you get a straight line, we're maintaining these prices in today's terms. in this instance, we're going to see is just if you were to just take £40,000 a year in monetary terms. So it doesn't increase with inflation. So over time, effectively, its buying power is going to decrease. So I'm just going to run that through now, and I'll show you an alternative in a second. Let's just assume we've got 0.5% on here. So we've got this is we're just holding it in cash. We hit save and calculate, and what we're actually going to be seeing in this instance here, that if the client wants to has £1 million, sits at £40,000 a year from that pension and sits it in cash, what we're actually seeing is that the system is now running up to 10,000 calculations in the system to see how realistic it is for you to take that. Now, what it's telling us here is that if you want to take 40,000 a year, only 16% of those are going to stay, 16% of those are not going to run out in the client's lifetime. So one of the things we can say is, look, you need to take some risk premium in order to meet some of your objectives, because the reality is you're likely going to run out in your lifetime. So if I just hit this slider here, and let's just say CashCalc default again, and they're a cautious risk profile. So just jumping into that one, here is our -9, maximum 18. And I'm going to hit save and calculate for you again, guys, okay? I'm just going to show you this now. So this is now, we're running it through a cautious model portfolio. And it's now running 10,000 or up to 10,000 scenarios. And in this instance now, because we've actually only got the maximum loss in any one year is -9, but with that, actually it's saying that in 10,000 random scenarios, getting that level of growth over that time, that 99.9% of those scenarios now don't run out of money. And the only other thing I would just draw you out on this one, let's just say, well, okay, you don't have, a risk profile 3 in theory would be adequate to meet your objectives. If I just drag this up to a 7, just to show you the difference here, and I'm going to hit save and calculate again. And we're going to run the same assessment through, but on a higher risk portfolio. And now what you can see is it's calculating these numbers, so it's building it up. In this instance, only 93% of those cases now actually end up not running out of money. And actually, we've got a case in this instance here, if I can just draw your eye to the very bottom of the screen, that one case is running out at age 77. So what this is showing is actually that because now we've taken more risk, and therefore we've got the capacity for that to fall significantly more, on a number of years, potentially you're running more of a risk that you're going to run out of money in your lifetime by taking more risk, and that just prompts a conversation in your with your client. So this is all very good, and this is the stochastic modeling, and this is running these scenarios through. But one of the main concerns that I have is that this is all well and good when you're talking about just static withdrawals, a set amount every year. Now, quite frankly, you could annuitize to just get a set amount every year. What we know in cash flow planning is that we're trying to look at these circumstances on a very personal basis. People's incomes might change over time, their state pensions kick in and things like that. So what I wanted to show you today is that how using the cash flow modeler can be done whilst incorporating it with a cash flow plan that you produce for a client. So what I'm going to do, I'm going to hand over to Ray in a second, because am I right in saying, Ray, that over the last couple of weeks you've been using a demo client, so example client here, and it was a real client for us. So what I thought we would do is if I get Ray to just give us an explanation of the client and what we've done so far in using cash flow modeling to establish a plan for this client, how we could then use this tool to further test that. So was that okay, Ray?
Yeah, that's fine. So if you go back to the client dashboard, now we're on the client dashboard, guys. You can see a clock face of pretty colors with the yellow at the top, and right in the middle there's the cash flow modeling. So if you can just click that, Matt. We've got over 25 calculators within CashCalc, but to be quite frank with you, 82% of all of the use of CashCalc is on the yellow onboarding tool and the cash flow modeling tool. And then so the cash flow modeling is actually the most popular tool, but the second most popular tool is the Monte Carlo, which is really ironic because I resisted building a Monte Carlo tool, and Matt and the other guys at Niche were nagging me and saying, look, I think this would be really useful. I think it'll be really popular. And I said, no, I don't think our advisors would use it. I don't think it'll be that popular. But I acquiesced and got my developers to build it, and it's now the second most popular. So what that said to me is that I've definitely not got the monopoly on good ideas, and I've definitely don't always make the right calls. But if you surround yourselves with good people and you listen to those people, then hopefully as a team you can make the right decisions. Okay, so we've landed in the cash flow modeling, and I'm hoping most of you have already used the cash flow modeling tool previously. But let me just very quickly summarize what you're seeing. There's 4 thumbnails there. Top left hand, I've called the case pre-advice, open brackets, old provider. So this was a real client that came to Niche actually, and it was a referral to Niche. One of our young advisors was dealing with this client. And during the course of dealing with the client, the advisor came to me for a bit of mentoring, advice, and guidance. And when I sat with the advisor and looked at it, I actually said that this would be quite a nice example on CashCalc. It's using a little bit of the functionality. So once we dealt with the client, the advisor just typed it up and called it example client. So we thought we'd use it. The top right, if I draw your eye, it says post advice, new provider, linear. So all I've done is we've re-platformed the products into a modern platform with cheaper charges, but we've made exactly the same assumptions. So on the top left, you can see it just about runs out of money and goes red, and on the top right, you can see that they don't. Bottom left, post advice, new provider, new asset allocation. That's where we've now projected using some variable returns. And then the bottom right, we've looked at adding a fear of theirs, which was what would happen if we needed to go long-term care. So Matt, if you can go into the pre-advice case for me, please. So whenever you log into a cash flow tool or a case, you'll always arrive on the assumptions page. And on the assumptions page, this is where you put the inflation rate, and it'll always default to what you've set in your system, but you can change it case by case if you want to. In this case, we've set it 2.5%. Just as a reminder, everything in CashCalc is in today's terms. I remember the days 20 odd years ago where I'd go and see a client, I'd do £50 a month into a pension for them, and I'd give them an illustration saying at 6% growth, you'll have £1 million. At 9% growth, you'll have 2 million. And at the 12% growth, which is what we're going for, you'll have 4 million quid, and that'll give you a pension of £150,000 a year in retirement. And all the clients thought that their 50 quid a month was going to make them rich in retirement. We weren't taking account of inflation, and we were clearly assuming very significant growth. None of that happens now. All illustrations on pensions are in today's terms. And so CashCalc has been built in today's terms as well. So the buying power needs to be maintained going forward, or it actually gets eroded. So if you just click on savings pots for me a sec, Matt. Well, you can see these clients have done fairly well for themselves. They keep a modest amount in their current account. And Mrs. had some very nice investments. She had £80,000 in some ISAs, and she had £250,000 in a pension. And then Mr. had a very nice pension too. He had £950,000. If I draw your eye to the center of the page, you can see that those investments and pensions we've set on 4% linear growth. And what these clients had said to us is that whilst they'd saved up during their working life, their pensions in recent years didn't seem to be going anywhere. They didn't seem to be going up much. And they'd left them with the same provider for years and years and years, and they felt that they wanted to, one, check whether the current providers were correct for them, and two, whether they had enough money to achieve their goals. So if we click onto incomes and expenditures, please, man. What we can see here now is that Mr. is 58 years of age. He wants to retire in 2 years' time. His wife is 3 years younger, and she wants to retire at the same time. So she's working part-time, and she intends to give up. And you can see there that Mrs. has also got a small NHS DB pension, which she's going to kick in when her husband is 60, when he's retiring when she's 57, and that's £1,500 a year, and she's got £4,500 tax-free cash to go with it. They both then get full state pensions. If I draw your eye to the bottom of the page, you can see all the red entries, which are their expenditure. Now the client, you can send the client a data capture form, and they can break down all their expenditure. And in general, in CashCalc, we have 2,000 data capture forms done each month directly by the client. And on average, it takes them about 20 minutes to do a full fact find. In this particular case, the clients were very happy just to say, look, we've looked at our bank statements and direct debits and putting food on the table and keeping the lights going. We spend about £1,500 a month. But in general, with just a couple of meals out and enjoying ourselves and buying clothes and things, we probably spend another £1,000 a month. So we'd like to have at least £2,500 a month just to survive. On top of that, then you can see we've got, they like to change the car every 5 years. And Matt, can you just click on edit on change car? This is something we added in response to feedback from users. You can see that I've put in there change car, and CashCalc, you can be as flexible as you want, and you can call the expense whatever you want. Just below that, the blue button that says expense, but below that you've got one-off every week, every month, every year. And actually now on the right, we've got something called custom, and that's something we only added in the last 12 to 24 months following feedback. It used to be that the maximum you could do is every year. So if somebody wanted to change the car every 3 years, they'd actually have to make an entry 5 times to reflect changing their car 5 times over the next 15 years. So listening to the feedback, we just changed it, added the custom. You only need to put 1 entry in from the age of 58 to 76, and they're going to therefore change their car 3 times. You just close that for me, please, Matt. And then below that, then on there, you can see enjoy in retirement. And again, you can call this whatever you want: splurge, spending, spending the kids' inheritance, going mad, whatever you want to call it. Whatever the client's terminology and language they use. So they said to me, look, we want to enjoy retirement, and we want to spend a good amount of money. And from discussion at the fact finds meeting, we estimated that they were probably going to spend about 24 grand a year on, you know, maybe some nice holidays, maybe treating the kids, grandchildren, and meals away, weekends away, meals out. So if you look at that, we've put 2 grand a month every month for the next 20 years. This is really enjoying retirement. And then below that, when they actually do retire, they want to spend 60 grand on a round the world cruise. Normally when we speak to retirees in Wales, their goal is something like going to watch the British and Irish Lions in the Southern Hemisphere. Seems to be a very, very popular goal for people retiring in Wales. If I could just take you over to the cash flow model now, please, Matt. And what we've got here is the savings over time. And Matt has moved on to, let's stay on the savings over time, Matt. So as you can see on the left-hand side, if you just mouse above the 950K pension, please, Matt. These clients said they didn't feel like their pensions were growing much. And if you mouse to the one to the next of it, please, Matt, and the one next to it, you can actually see it actually is going down. Everything in CashCalc is in today's terms. We've already put down that inflation is 2%. I've forgotten, if you go to charges and fees a second, Matt, okay, you can see that having got information back from the provider, on average, the charges were about 2%. So if we go back to the cash flow model, so 4% growth, but take off 2.5% inflation, take off 2% in charges. These current pensions not even keeping pace with inflation. So the clients were right to come and take some advice from us. But actually, what you can see on the right-hand side, where it's just turning red, these clients have got enough money to achieve their goals, including £2,000 a month spending, but there's a risk of them running out of money in their 90s. Okay, so the first thing we can do is to clone this forecast. There's a button to the top right, a blue one saying clone forecast, or press one of the plus buttons and you can clone a forecast. So if you spend 20 minutes building a forecast, you can literally spend 20 seconds copying it. You can then go in and make some very small changes. So if you go to charges and fees, Matt, and then click onto the post advice, what you can see is I've cloned it, and then I've literally just gone in, changed the name of old provider to new platform. And in your case, I would say if you use Royal London, you just say Royal London. If you use Aviva, say Aviva. You use Transact, you say new Transact pension. And then what you can do is put in the charging structure for your new products. So we've got 25 basis points for the platform, and then we've got the funds of 22 basis points. And then what we've got at the bottom, if I draw your eye, we've got a 0.5% advisor fee, which we're putting against the husband's big pension. So we're earning just under 5 grand a year in fees. And then there's an initial fee then, which you can do on a monetary basis. Any fees or charges you can either do ad valorem, percentage-wise, or you can do fixed fee. So if you now go down to cash flow model, Matt, so we've cloned this forecast, gone in, changed the charging structure, and what you can see now, the client can still afford to achieve their goals, and actually they don't run out of money. But if you just go into money in versus money out a second, Matt, what I want to do is just show you what we're going to do before we go over to the Monte Carlo simulator. On the money in versus money out, what you can see is a series of colored blocks, and you can see a black line across the top. So the black line across the top is actually the expenditure line. And what Matt has done there is moused on the right-hand side, and that's 30 grand a year net, which is the £2,500 a month they want. 1,500 quid to keep the lights on, £1,000 to get by. But if Matt slides that to the left slightly, what you can see there now, that's where they're spending 24 grand a year on it, enjoying retirement. And the three peaks then is where they're changing their car. And then the biggest peak on the left-hand side is where they're doing their British and Irish Lions tour. In this case, they're looking at the silver anniversary cruise. So there's their expenditure line. And just for your information, this week we launched a new portal. And on the new portal, you guys may have noticed that when we ask the client to do the data capture form, or you to do it, we're actually asking them whether it's essential expenditure or desired or discretionary expenditure. And once we start building up some data, we're going to have two black lines on this page. There'll be a solid black line, which is I can't drop below that line because that's my keep the lights on one. And then there'll be a broken black line above it, which is the line the clients want to achieve to enjoy their life. So that's a little improvement we'll be making as part of the client portal. But in this case, if I draw your eye to these colors now, and if Matt, if you go down and mouse above the yellow one, what you can actually see is that the little DB pension we put in for Mrs. Client, there it is there. But I know as a financial advisor that Mrs. can earn £12,500 a year before she pays any tax. I know that because I'm a financial advisor. So what I've done is I've just added a specific drawdown from her pension of £11,000. And if you go to contributions and withdrawals, please, Matt. At the top there, you can see there's a drawdown tax-free up to the personal allowance from Mrs.'s pension. And I've just set that as a drawdown. And you can see below that, I've done a set drawdown for Mr.'s pension of £12,500. I've done that between when they retire and when their state pension kicks in. And if I draw you right down below to the bottom of those withdrawals, you can see that when their state pension kicks in, we've actually lowered the drawdown at 0% tax. So people say to me, oh, CashCalc, I love the simplicity. Can you add taxation in as well? Well, actually, you can already do taxation. You just need to think as an advisor. Okay? And 95% of our users are already happy with the simplicity of CashCalc. Having said that, my team are working on making it even easier for you to take account of that tax, which I'm showing you how to take account of here now. If you go back to the cash flow model now, please, Matt. So let's go down to the orange on the left, which shows that that's Mrs. is 11,000 tax-free cash. And if you go to the olive above it, that's Mr.'s 12,500. If you slide to the right now, you can see that the purple is where Mr.'s state pension now starts. So what we've done, if you mouse above the orange, Matt, what you can see, there's the top up to Mr.'s state pension to use up his personal allowance. And if you just mouse on the gray above it then, Matt, that is the shortfall from their fixed or guaranteed incomes or their set drawdowns, which they need to meet their expenditure. And in CashCalc, that will then just take it automatically from their savings pots in the order that you put them in. So Matt has moused above there where you can say that they need another 28,000 because it's coming from his pension. When we've put his pension in, we've said, look, if we need to dip into this automatically, what's the tax rate? We put 20% in, so you can see it's grossed it to 36%. 36,000, sorry. I'm just going to, before we go to the cash flow modeler, I just want Matt to go down and look at the key or legend at the bottom where it's got the colors. I'm not sure whether you're aware, guys, but you can actually click on those buttons and it will disappear. Sorry, make disappear the income. So click on that one, Matt. Also click on the turquoise one, which is on the next page, Matt. So if you click on to the right, get rid of the, what you can see there, I've just pressed the button and removed two of the incomes. Now, if you press the purple back in, Matt, and then press the turquoise back in, literally in front of the client, if you want to, guys, you can actually remove all of their incomes just have their black expenditure line, and you can just bring their incomes in one at a time and say, you've got this guaranteed, you've got this guaranteed, you've got this, and you can build it up if you want to. So CashCalc is a tool that you can use however you want to do it. But what I want to do now is I want to hand back to Matt, because what you can see on this is the clients have different drawdown needs from their two pensions. And Matt is going to go back to the Monte Carlo in a second and show you how you can put those varying drawdowns into the Monte Carlo tool. Is that okay? Back to you, Matt.
Yeah, brilliant. Thanks, Ray. So exactly as Ray's just alluded to, we've now got a situation. This is a real life client. What we've now got is, rather than just saying, oh, well, what's the sustainable withdrawal rate from this part or whatever, no, what we've actually asked the client is, what do you actually need in retirement? What do you want in retirement? So we're talking about goals, aspirations, desires. And then what we've done is we've built that up into this section. We said, well, look, give or take using your tax allowances, here's what we can have. So what we now have is a genuine draw from the pensions or from their investments that this client needs. So this is, like, talk about, this is directly for this client now. So what we're going to do is say, well, okay, now we've established that according to our cash flow, and I just look at this here, we're not going to run out of money. Now, this is on the assumption that we're getting 2%, or one in this instance, we're getting 4% above a 2.5% inflation rate. So we're only getting 1.5% above inflation in this example. Now, that it doesn't matter whether you had varying inflation in this instance. What we know is that because we're just talking about above inflation. So in this instance, we're saying, well, look, in theory, if we can get 1.5% above inflation, we're going to be hunky-dory till we're 100. Now, that's based on linear. I know that we've had the discussions in the past, and you can see it on the variable about when we stress test is, well, what about sequencing of returns? Does it make a big difference? Yes, even if we average 4%, what about the sequencing of returns? So you can do that by using the variable template, as we've sort of alluded to before, which is where we use 30 years worth of historic data and say, well, if we had exactly the same as we had before and we just project that forwards, would this plan have survived? Now, that I think that does a really great job of just being able to test and say, well, look, if we just had what we had before, that's great. And then we can put other stress tests in, so we can put market events in. And again, if you guys have not seen that in action, I would just jump back to one of the previous videos that Ray has done, just to see how that works in action. But what we want to do in this one is, okay, well, that's great. It works if we have a nice linear return. It works if we were to run it in the back, run it through data from the last 30 years as a sort of static variable. But what about, let's run it through 10,000 completely random scenarios to see if what this client actually wants to take is robust in all of those situations. So what we're going to do in this one, and this is we will admit, and we were saying this before, is there's a little bit of a workaround required at the moment. However, I have been hammering this, and beating this drum for some time. So in the near future, what we're going to see is the ability to draw the exact pot withdrawals every year from that are put on these pensions. So in this example, Ray's already alluded to the fact that, say for Mr. So we're going to take Mr.'s pension here. We've said that we're going to take £12,500 a year within his personal allowance directly from his pension until the client is 66. And then once his state pension kicks in, we're going to drop that down to 3,700 to retain. But what we know is that because they need a bit more, if I just draw your eye to this box here, it says that we're going to be taking a further 36,000 from it. So what I've done, I've grabbed that information out of here and said, well, look, this is the direct draw on these pensions every year. Now, that can either be taken from this screen, so you can see that he just needs an extra 36, and then at 80, because he's now not splurging as much money, it drops down to 6,200. Now, you can either pick that information directly from this graph, or if you go into the yearly breakdown and click on any of the, if I just click on the age 72 entry here, and just draw your eye in this instance here to, I'm just looking at this now. So if you can actually see the direct draw, if I draw your eye to the right-hand side of the screen here, it says personal pension, and it shows you how much is being drawn and from where. And if you open up, if I just open up a year before, and again, draw your eye to the same place, you can see it's been taken from the wife's pension in this instance. But you can get this information from within the cash flow. And what you want to do then is we want to take this over and say, well, okay, is what this client actually wants, so a big tax-free lump sum that we can see here, he needs to be drawing this 12.5, and he needs to be drawing these extra little bits. Is that achievable in 10,000 scenarios? So what I'm going to do, I'm just going to jump back to the client dashboard, so you can see that button at the top there, guys. And and I'm gonna jump into the Monte Carlo simulator. And as you can see, I've got a couple of examples. I'm only going to show you the one today, but in this instance here, we've got Mr. Example Drawdown Assessment. So I'm just going to click View this option here. Now, again, let's just double check the assumption things that we got. So eyes to the left-hand side of the screen. We've got his 950,000 pot. So we know that's what we're starting with. We're not interested in putting a floor in this instance because we just don't want it to run out in his lifetime. I just draw your eye to the withdrawal section now, guys, so which is on the right-hand side in the middle. And I'm just going to click the edit button so you can see the sort of entries we're putting in. So in this instance here, we know he needs to draw 12,500 within his personal allowance. So this is the gross amount, the gross withdrawal. And he's going to be drawing this every year. And he wants to start this from age 60. And we know he wants to do this until state pension age. Now, one of the assumptions we've made in this instance is that we think that we've made the assumption that the personal allowance is going to increase every year, by an equivalent amount to inflation. We don't know if that's going to be the case, but that's the assumption we've made in this instance here. And if I just show you these other ones, so I've just added a series of withdrawals that are directly related now to his plan that we've just put into CashCalc. So here's the tax-free cash lump sum that he wants to take at 61. You can see there's the 36,000 a year between 72 and 79 that the system worked out that he needed. And there's the 6,000 a year from 80 to 100. And then this 15,000 is actually one of the cars that, one of those repetitive car purchases that we've got in there. So this isn't just a sustainable withdrawal rate. This isn't just, what's the maximum he can draw? No, this is based on the client's needs and based on, that we can take it from a variety of pots over time. Is this client's withdrawal requirements on that pot sustainable over time? Now, when we did an attitude to risk questionnaire with this client, he actually came out as a risk profile 3, or we use E-value, so he was a 2 or a 3 out of 5. But that will be dependent on yours. Now, you can either, as I alluded to earlier on, you can either use our default asset allocation, which will just give you, as you can see on this left-hand side, in this instance, a -9 or maximum 18 with an average of 5.3 over time. However, you could put your own in this instance as well. But if I just now hit save and calculate on this instance here, and I'm going to run this through just so you can see it. And as I sort of mentioned earlier, it runs this scenario through 10,000 randomly generated example scenarios. And it does this every single time. So you might not always get an absolutely identical answer, but you probably won't get anything more than about a 0.2% difference. And that is because we're genuinely running 10,000 calculations every time we do it. Now, in this instance, what we can see is based on this client's genuine own withdrawals, based on a risk profile 3, we're looking at potentially that is never going to run out of money in his lifetime. Now, we can see that some of these run down as, we're running down, close at the end of his lifetime. However, we haven't got a risk. So we could say, well, okay, well, that's fine if we did a risk profile 3. What if I bump that up to a 7 again? Let me just slide that and re-click that calculation now. And one thing to be aware of, guys, is look, this is live. I'm not doing this, I'm not doing this pre-prepared. This is me running those calculations live. So this is just run that whilst we're on with another 100 people. And in this instance, you can see that because now we've introduced more risk into the situation. Yes, in some of these circumstances, this running off into the sunset hugely, but actually what we've done is we've introduced scenarios where they are running out of money in their 80s in this instance. So one of the questions again is we can say, well, based on your needs and based on what you actually want to draw, you only need to take as much risk as required. And I think what you're able to do in this is, one, you've now said, well, look, in theory, we should be able to maintain this level of drawdown. Now, we're going to review this every year. We can come in and tweak it. But at this moment in time, based on your wants and your desires and what you're asking us to do, if we ran this through 10,000 scenarios, you don't run out of money in your lifetime.
Matt, can I again? I haven't seen this. If we put him in cash and run it again, what's the output? Well, I've not seen you do this one in cash. I've seen risk level 3 and a 7. So I'd be interested to what it says. And whilst it's doing it, we can see that there's actually less than a 50% chance that these clients would have success. So, whilst we're not saying this is definitely exactly correct, 'cause it's a forecast, what we want to do is get the client in the correct ballpark. And if the client is now de-risking and wants to go to cash, they're in the wrong ballpark. They definitely need to take some risk but actually they don't need to go mad and take massive amount of risk. So I think that's what it's saying to me, Matt. I don't know about what you think.
Yeah, no, exactly. And I think that's what we're doing. So in this instance, we can say, well, look, if you just sit your money in cash, then you're in a position where you're very, very likely you're going to run out of money in your lifetime. So we need to take some sort of risk premium, which is that conversation. We've proved that we need to be taking some risk in order for this client potentially meet their objectives. So if I'm just going to, again, just jump back to that CashCalc default, drop it back to a 3. And if I just draw you out to the left-hand side just quickly again, we've got the annual advisor fee and the product charges that we've lumped in here. So this is now reflective of the fees that we mentioned. So that's your 0.5% plus the 0.25 for the platform plus the 0.22 for the funds in this instance here. So what we've now got is, rather than just a general Monte Carlo assessment or a general stochastic one, this is now a personalized stochastic model based on your own withdrawal needs, based on the actual product charges that you're likely to be paying. Now, again, it's still forecasting. There's still a lot of things liable to change. But what we've done in this instance, we've put it through 10,000 randomly generated versions to try and run that through as many sort of scenarios as you can see. So what I would never do is to say this is any more accurate, because what we're really doing is there is, you know, accuracy in forecasting is the pursuit of the impossible. It's much better to be broadly accurate than precisely inaccurate in these things. But what we're doing here is that we're saying, based on some general assumptions, based on some of the things that you'd like to do, running it through 10,000 scenarios, you know, I think this is a relatively robust plan, and it looks like it will work. Now, the other thing that may be the case, and this is one of the considerations you will have, is it might not always be the thing that you want to present to the client, because quite rightly, sitting there and saying, well, there's only a 50% chance that you're going to succeed, so potentially that is not going to be something you can have a conversation with the client. However, I still think this would be quite good on your due diligence file. So it's one of the things that I say within my practice, and we've just done this as well, is I'd expect to see this put into the due diligence file, even if we don't think it's appropriate to present to the client. At least from our due diligence perspective, we've actually gone in and tested to see whether the plan that we've suggested, the ideas that we've come up with, potentially would work over these randomly generated 10,000 scenarios. So
Matt, can we just have a quick look at the report it'll produce? Because you know, I'm an old WYSIWYG guy, so what you see is what you get. So you've done a few scenarios there. Do you want to just talk through them?
Yeah, exactly. So as I said, guys, I'm not going to go through all of these today, but if I've done exactly the same concept for the wife, so she had her £250,000 pension, so I've done exactly the same for her. In this instance, I wanted to test that long-term care scenario. But what we've got is that we've got the ability for you to do one of two things, and this is the same across the board in CashCalc. You can either produce a Word report. Now, the Word report means that you can go in, you can add sections to it yourself, you can move those bits and pieces around to fit your own suitability reports or fit your own needs. So if you want to add more commentary to an individual item, you can click on the Word report and you can do that. Alternatively, you've got the PDF report, which is a static, static time-stamped item that you can produce. And if I'm just going to click on the PDF report for you guys so you can see what we do. As Ray has just said, we sort of look at WYSIWYG. So what you see is what you get. So we just want a direct output that is exactly what you've just seen on the main screen. And if I just slowly scroll down for you, as you can see in this instance it's branded, whereas normally this would be your own branding. You'd have the name of the client in this instance and who the planner is and the name of your company. Just a very quick introduction, and again the overview, just what we're showing you in this instance. But if I just scroll down, here's your entry. So exactly what we've just seen on screen. Pot size shouldn't drop below X. Advisor fee in this instance. Simulation end age. And as you can see in this instance here, here's all those income drawdowns that we've put in and what we've asked of it. In this instance, the last one we did was just a cash example, so it's just showing that. Whereas on the other ones, we were seeing that breakdown of asset allocation. And then in this instance, you can see that if you leave it in cash, you've got 47% of them are gonna run out before the end of your lifetime. And what we've also got, which we didn't show you, which I'll just quickly jump back to now, is we've given you a numerical output based on the average return, a pessimistic return, and an optimistic return. Now how those are worked out in CashCalc, just really quickly, is the average line is the median. So if you're looking at average, that is the median. So that's the very middle of all of those scenarios, the very middle scenario. And then what we've done is got standard deviation either side of that. So you've got your optimistic is your top quartile. So if you were thinking about it in terms of funds, yeah.
I'm still looking at the PDF screen. Have you swapped screens?
No, I haven't swapped screens. I was just chatting about this here. But if I just jump out of this and I go back to where I was showing you now, it might be slightly easier if I show it to you based on an attitude to risk. So you can see those lines separated a little bit. But we've got 3 lines that we've shown in here. The blue line, as I just quickly said, is the median. So that's the very middle, and that is showing an average return of 5.4 in this instance here. The green line is the optimistic return. So if you were talking about funds, that is the top quartile performer. So that's the top 25%. And the red is your bottom quartile. So that's your that's the 25% line. So that's, if you're just looking at this, that's what they're alluding to. And it just gives you a year-by-year breakdown of potentially what those values are worth. And you can see in this instance here, the difference between a bottom quartile performer and an upper quartile performer is nearly double the value. So just something for your, when you're looking at these and what's that's trying to show you as well, guys. On this section, that's me done, guys. So Ray, is there anything else you just wanted to bring up on that instance there? Or do we want to throw it over to Sol?
Well, while Sol is getting ready, because I can see she's answering 23 questions. So Matt said to you there's a bit of a workaround this morning, and that's down to me. When I agreed to build this tool, I made it a standalone tool. Now that it's become the second most popular tool, Matt and the other guys and some users around the country are asking us to fully integrate this tool into the cash flow modeling stress testing section. And that's what we're looking to do. So for the moment, Matt's had to go in and manually pull some of the data across, which is mad because I've got a system that should be integrating it across. But that's some of the things you do when you build software. You don't know how successful some parts will be. So behind the scenes, my guys are building it so this will be dropped into the stress testing section. When all of the figures are produced for the needs from each one of the pots, you can literally just say, run this through a Monte Carlo. So for the moment, you've just got to go in and manually type them in. So it might take you another 10 or 20 minutes to build it at the moment. But bear with me, I'm working on that.
We will be uploading a copy of this as well. So I did see that come in. So we will upload a copy of the webinar so you guys will be able to do that because we've been recording today. So hopefully you should be able to share that with your colleagues. But that's everything from me. Hope everyone stays safe and see you soon.